Whenever markets experience a sharp decline, it's natural for investors to feel the urge to act. The common instinct is to try to anticipate the downturn and move to cash before further losses occur. It sounds simple, but timing the market is a form of speculation, not a disciplined investment strategy. Short-term emotional thinking can easily interfere with long-term decision-making. To illustrate this, let's consider a client who is fully invested and generating both income and growth. Over time, a moderate growth portfolio may produce a combination of dividend income and capital appreciation. If a client decides to move entirely to cash, several things happen immediately. First, the nature of the income changes. Dividend income, which is generally more tax efficient, is replaced with interest income, which is fully taxable in a non-registered account. Second, the opportunity for capital growth is eliminated while the client is on the sidelines. And third, any unrealized gains in the portfolio may be triggered, resulting in immediate tax consequences and the loss of future tax deferral. In addition to the tax impact, there's also several structural challenges. If an investor sells at a loss and attempts to repurchase too quickly, they may be subject to superficial loss rules, which can deny the tax benefit of that loss. But beyond the measurable factors such as income and tax, the biggest challenge is timing itself. For a market timing strategy to work, two decisions must be correct. First, the investor must sell before markets decline. And second, they must reinvest before markets recover. Missing either step can significantly impact long-term results. Markets can rebound very quickly, and the best and worst days often occur close together, making it extremely difficult to step out and back in at the right time. Even missing a small number of strong market days can have a profound impact on long-term returns. In most cases, investors who attempt to time the market end up reducing their returns, not improving them. Investors who sell during periods of uncertainty often find it difficult to re-enter the market once it declines further, as fear tends to increase rather than decrease. As a result, they may remain in cash too long and miss the opportunity to recover. Instead of trying to predict short-term market movements, we believe a more effective approach is to remain disciplined and maintain a long-term perspective. Volatility is a normal part of investing, and declines occur regularly within the broader uptrend of a market. One practical way to manage this is through a focus on high-quality investments. Companies with strong balance sheets, consistent earnings, and durable business models tend to exhibit lower volatility and provide better long-term outcomes. This approach allows us to stay invested and use periods of market weakness as opportunities to selectively add to positions rather than attempting to exit the market altogether. If you liked this video, you can discover more videos in the Greenard Exchange section of our website. You can also read both past and current articles in the Greenard Index section. Thanks for listening.